Welcome to today's Institutional Explainer, where we're going to break down the structural and macroeconomic drivers for gold, strictly focusing on the raw data. If you're looking to elevate your market perspective, shifting from retail speculation to true institutional precision, well, you are absolutely in the right place. Today, we're putting on our hedge fund research hats and examining the XAUUSD market through a completely objective, data-driven lens. Let's dive right in.
Here is our roadmap for today. First, we'll cover macro catalysts and geopolitics. Then, we'll look at the institutional gold market structure. Third, we'll run a smart money concept analysis. And finally, we'll map out some high-probability trade scenarios. All right, kicking things off with Section 1, Macro Catalysts and Geopolitics.
Just look at the sheer certainty currently priced into this market. According to the CME FedWatch tool, there is a staggering 98.4% probability that the Federal Reserve maintains its target rate right at that 350 to 375 basis point level for the upcoming meeting. That's basically a lock, right? Now, this massive probability heavily influences the strength of the US dollar. And as we know, a resilient, strong dollar acts like a heavy anchor on gold prices. We're also seeing incredibly robust US employment data, things like the recent ADP payrolls and JOLTS job openings, which just further reinforces this narrative that the Fed is going to keep rates higher for longer.
But it's not just the Fed we have to watch. We've got these overlapping geopolitical and energy narratives acting on the market right now. For instance, the recent Israel-Lebanon ceasefire has temporarily suppressed the risk premium we normally see in commodities, and that's actually pulled WTI crude down to the $93 handle. However, geopolitical fragility is still a massive variable here, especially since US leadership has explicitly noted that this ceasefire is contingent on there being zero US casualties linked to Iran. Meanwhile, out of nowhere, EIA crude inventories plummeted by a massive 8 million barrels, literally double the expectations. So amidst this really complex backdrop, the US dollar index, or DXY, is pushing up and testing that critical 99.50 level. The big takeaway here? Safe haven flows into gold are currently subdued because of the ceasefire, while a steady dollar just continues to apply relentless downward pressure on the metal.
Now, as we approach the New York trading session, we are keeping a very close eye on the economic calendar, specifically the US unemployment claims data. In an environment where the Fed is just hyper-focused on labor market resilience, this specific data release is going to serve as the primary liquidity injection for today's price action. Make no mistake, institutional desks are waiting for this exact volatility window to execute their accumulated orders.
Which brings us to Section 2, Institutional Gold Market Structure. When we place the 4-hour chart right next to the 1-hour chart, we observe a really decisive, frankly unarguable bearish alignment. Notice how price is consistently generating lower highs and lower lows, all originating from that 45-20 supply zone. This isn't just some random intraday fluctuation. This is a sustained, impulsive move downward after breaking previous bullish structures. The market is behaving like a highly controlled descent.
And the technical confirmations perfectly mirror this structure. The momentum is clearly, completely controlled by the sell side. We can see price trending firmly below both the 50-period and 100-period exponential moving averages across these multiple time frames. But it's not just that price is below them. These EMAs are fanning out and diverging downward, which is just a textbook hallmark of strong bearish momentum. Furthermore, if you look at the MACD histogram, it's deeply negative, confirming that heavy sell-side volume. Every single time price attempts even a minor recovery, it faces immediate, aggressive rejection at these dynamic resistance levels.
Let's dig a little deeper in Section 3, Smart Money Concept Analysis. Before we analyze the intraday charts, let's just make sure we're all on the same page with two critical concepts. First, a change of character, or ChoCH. This is essentially the initial break of structure that signals a potential shift in the overarching trend. Second, sell-side liquidity. Think of these as massive pools of pending stop-loss orders resting just below old obvious lows. Understanding these two concepts is absolutely essential. You see, institutions don't just sell randomly into the void. They deliberately drive price into these liquidity pools so they can fill their own massive orders without causing slippage.
All right, zooming into the 15-minute time frame, we can actually see these mechanics playing out beautifully. We can identify a fully completed liquidity sweep that occurred right below the 4470 level. Now that sweep confirmed our bearish change of character. And by doing so, the market has established a highly refined premium supply zone sitting right between 4480 and 4490. This is exactly the territory where institutional algorithms are going to be looking to aggressively re-enter their short positions. And this dynamic creates an incredibly dangerous situation for the uninformed trader. Retail traders often fall into this psychological trap of buying at what they perceive to be minor support levels during a heavy downtrend. Essentially, they're attempting to catch a falling knife, just because they think the asset has gotten too cheap.
But by doing this, they're actually providing the exact liquidity that market makers need to offload their positions. So, while retail is out there desperately buying the dip, the institutional side is just patiently waiting for a pullback into that premium 4480 to 4490 supply zone. They'll use that bounce to continue the overarching bearish trend and drive price into even lower sell-side targets.
So how do we actually trade this? Let's move to Section 4, High Probability Trade Scenarios.
Here is the exact architecture of our high probability scenario. Based on everything we've looked at, we are entirely prioritizing short entries on a retracement back up into that 4478 to 4490 zone. We're basically waiting for that retest of the 1-hour EMA and the 15-minute supply block. Our strict invalidation point, our stop loss, needs to rest safely above the liquidity pool at either 4492 or 4505, depending on how you manage your own risk tolerance. For targets, our initial take profit is at 4455, but our ultimate objective is that massive untouched sell-side liquidity pool resting all the way down at 4380. If it plays out, this setup yields a highly asymmetric professional-grade risk-to-reward ratio of 1:3.
To summarize the logic behind this entire setup, keep this core principle in mind. Market makers are pushing price down to seek liquidity at lower levels after a distribution phase. Our entire objective with this explainer today is to simply align ourselves with that institutional order flow. We aren't out here trying to predict bottoms, we are anticipating further bearish continuation based strictly on the structural evidence presented right there on the charts.
So, as the market prepares to price in the incoming US unemployment claims data, volatility is absolutely going to spike. The real question is, when it does, will you fall victim to the emotional retail trap of trying to pick the absolute bottom, or will you patiently execute alongside the smart money from those premium supply zones? Ensure your risk is strictly managed, keep your position sizing responsible, and above all, make sure your bias remains entirely objective. Thanks for joining me for today's institutional market analysis.